Today's analysis starts with the yield spread and how it's currently affecting a multitude of asset classes. The spread has flipped its wigs and has dipped into a degree not seen since the 80s, and it's forcing us to consider the implications of this macro structural change. How can we invest from here on? If you are confused what to understand, whom to believe, what to do with your positions in stocks, crypto or gold, this video will guide you through the recent events related to the banking crisis and provide clarity through the chaos. In this episode, we'll start by exploring the most important chart right now, the long-term treasuries market. Things are definitely different than what we have seen in decades, so any new trade ideas need to consider these changes happening in the bond markets and how they impact other markets like equities, metals and cryptocurrencies. Trust me, this video will be packed with actionable information that will leave you better equipped to navigate through the contradictions and confusions around the current situation. We'll put everything in context and let the charts speak for themselves. So buckle up and let's get started. On the technical front, looking at the 30-year yield chart, we are now seeing something new, a polarity flip where a multi-year channel's resistance was broken and became potential support. The fact that the yield has abandoned a decade-long channel implies that whatever happens next on the macro front, it will be faced with different responses by market participants. There are two possible short-term scenarios. Either deflationary spirits are allowed back into the market, bringing the yield down at least to the new support levels, if not beyond, and back to the decade-long descending channel, or interest rates maintain their upward trajectory and a new ascending structure evolves from here in the long-term yield charts. As a technician, I'm leaning towards a combination of both scenarios that I will tell you more about. Before we leave this chart, look at the daily structure. Don't you recognize an impulsive third wave in the making or a flag pattern? But aside from how we label this recent price action, continuation patterns suggest that the spike may be not over yet. But if so, the difference this time is that a retracement in yields will meet ascending support, which is different from past deflationary scares where falling yields, rising bond prices, faced market forces that were backed and motivated by central banks' actions or wordings. From now on, every dip to support can be followed with another up leg if smart money changes its interpretations on the official postures. The charts are telling us that there will be no flight to quality as before, where you buy the long term to save yourself. This time, any dip in yields, which corresponds to an increase in the bond prices, may be an excuse to dump bonds even further, following a bear market in sovereign debt. This very same structural play can be confirmed with equities charts that could fall into the next weeks and months together with yields, but also equities are still supported accordingly to their charts. This support is even more significant in some markets like gold. You are about to see another chart of gold that will make you look at gold from a much wider and realistic perspective. And I'm not talking about switching to a larger time frame. The rise in long-term yields has been partly caused by governments keeping interest rates too low for too long, and this has led to another banking crisis that could be even worse than 2008 because this time it has to do with a yield curve that affects all banks, and that's a systemic problem. For a long time, money was very cheap with low rates, so institutions allocated the new money into long-term treasuries for the best yield. But now that interest rates are rising, these institutions can't invest anymore in long-term debt because if for whatever reasons they need to liquidate those treasuries, they will have to do it at a loss. This creates a real risk that these unrealized losses could become actual losses should banks need to sell treasuries to meet liquidity needs. So it's a pretty serious situation. If this happened because unsophisticated forecasting abilities by the banks or poor risk management supervision, it's not what matters most. What matters is that to avoid an eventual run on the banking system, authorities have stepped in to guarantee deposits and also help with this so-called mismatch of duration. And if they backstop the system one more time with any sort of monetary stimulus, and by the way, what we see here is the Fed's balance sheet and how the recent injection has eaten up the tightening of the last 5 months, that monetary stimulus will lower the perceived value of other assets over time, so capital may accelerate the exodus from the banks towards what it considers scarce supply assets. This other chart shows how the changes in the Fed's liquidity have led to new bull legs in equities. So even with deposits guaranteed, people will not lose money by keeping it in the banking system, but they will want to figure out where they can invest to offset the perceived loss in purchasing power of their savings caused by money injections that end up on the Fed's balance sheet. Rate cuts and more monetary stimulus are all but a certainty for many market analysts now that the banks are starting to show some cracks. This can be seen in the market expectations for rate hikes via the Fed funds futures. This chart is showing a 0% chance of tighter monetary policies from June onwards. But the thing is, this doesn't mean that inflation is going to fall. There's another macro condition that's not being taken as seriously as it should, and I will get into that later on this video, so be sure to stick around. Let me break down the situation for you by analyzing a few more charts. The bond markets have 10 times the amount of money invested in them than the equity markets. A significant amount of that money has shifted into short-term debt, inverting the yield curve, as we can see here with the difference between the 30-year and the 3 months treasury, now below the 0%. Meanwhile, we notice that some of the capital has moved into cryptocurrencies, such as Bitcoin. If we look at a log chart, we can see that it has broken through a very important descending resistance from its all-time high in November 2021 and is heading towards the next overhead target at 38K. Bitcoin has also been supported at 22K with an ascending dynamic line from its lows in January 2023, and if it clears the blue secular resistance line and turns it into support, we might see it conquer its all-time high again by October this year, which represents a potential gain of 140%. Did you know, by the way, that the purpose of Bitcoin to serve as a vehicle during times of monetary instability was hinted at in its Genesis blog, where it referenced a London Times article from January 3rd, 2009 about the British government bailing out banks during the financial crisis? And I stress the word vehicle here because not everything has to do with banking crisis. I will explain that when wrapping up the analysis. Now let's talk briefly about some benchmark indices. The Nasdaq has been performing well with a rounding base building, recovering some of last year's losses, but it hasn't made a clear break above any significant resistance on a log scale yet. However, if it breaks above the 14,500, we might see it reach 25,000 in the not too distant future, while the risk is losing the 11,000. The Dow Jones, on the other hand, has been trading above a descending resistance from its all-time high, at least in dollar terms. It might retest the 29k level in the short term if bond yields start to unwind, but if the support holds, we could see trade above the 40k this year. Specific trade setups are out of the scope of this video, but keep an eye on the 29,500 because a sustained close below opens the door to the 2600 and also to 21,000. Finally, the S&P 500 has also recovered almost 40% of last year's correction. If it breaks above the 4,200, it would confirm what we have already seen in Bitcoin and also gold. We'll talk about gold in a moment. I would like to invite you to click the like button if this video has been eye-opening to you thus far. It just takes a second compared to the time required for its production. I appreciate you doing that. Thank you. While textbook analysis suggests that an inversion of the yield curve is a leading indicator of a recession, there's another macro factor that we can't ignore. If we take a closer look at the Fed funds effective rate, we can see that rate hikes started with the war in Ukraine, and not as a reaction to the inflationary pressures that were mounting for 2 years prior caused by the COVID-induced shutdown. At that time, the Fed did not respond with higher rates. The timing in March 2022, when the Fed renewed its rate hikes that it started back in 2015, is what leads us to infer that war is a major concern for central banks. Even if they haven't said it outright for political reasons maybe, their actions speak for themselves. And as technicians, by looking at charts, we build our inferences and narratives accordingly. What does this mean for investors? We have seen that major capital is flowing out of long-term investments and into short-term bonds and risk-associated markets. Smart money knows that any long-term bond investment during a period of war is likely to result in a losing trade. War is a primary driver of inflation, and for central banks, it's incredibly difficult to contain this type of inflation. It's a tough situation, regardless if the economy turns down and enters a recession, just as what happened during other wars in the past. Have you ever wondered how wars and currency debasement are related? In ancient times, when a government debased its currency, it caused deflation. Why? Because people hoarded the vast money supply that was in circulation. As a result, the government had to debase the currency to keep enough money in circulation. But the more people hoarded, the more commercial activity and economic growth shrunk. This resulted in a reduction in tax revenue, forcing the government to further debase the currency to make up for revenue shortfalls. Fast forward to today, the same hoarding behavior has been happening under QE and ZIRP policies, where investors have been trying to hoard. But it's not that easy to hoard electronic and paper currency, so where does the hoarding go? Well, it's expressed through a migration to tangible assets like shares, metals, cryptocurrencies, and also art pieces and antiquities. This is a macro background that any investor should consider in their idea generation. The fact that many of these asset classes are behaving as vehicles. So, what are the key takeaways? Well, within less than 6 months in its effort to fight inflation, the Fed went from the fastest tightening pace in history, 3 consecutive 75 basis point hikes, to engaging in coordinated USD liquidity operations with other central banks amidst a banking crisis known to be a marker of a deflationary process. When bank lending declines, economic growth slows down. This raises the question, can we still experience asset inflation in the form of rising stocks and precious metals during a deflationary period? The answer is yes, for two reasons. First, we are still dealing with the consequences of the COVID-induced shortages of supply. So the Fed doesn't need to increase rates to cool off the economy. It's not a demand pull type of inflation where aggregate demand is growing at an unsustainable rate. Second, asset prices can rise during a deflationary wave, especially when taxes increase and banks become untrustworthy, leading to a capital flight to quality, where quality is understood by anything that can replace government bonds. It is not a speculative boom whereby people expect to make money on a rise. Instead, it's a bull market climbing a wall of worries. This was the primary driver of many bubbles in the past, including the famous tulip mania. It seems like the charts are announcing the end of an epoch of free money that led to a lack of understanding of risk management and to poor independent thinking, an epoch where institutions became comfortably numb in their forecasting abilities and risk control. Perhaps because the talking heads on TV and headlines were all preaching that inflation will be transitory and the central banks would keep rates low forever while ignoring the implications of the war entirely. Do not get trapped by the yield curve and understand that this flight to quality is probably not over yet. Even if the inflation headlines give way to a deflationary hysteria and equities, Bitcoin and gold start correcting in the short to mid-term, any dips to meaningful supports would be considered buying opportunities to escape the rat race and get ahead of the crowd. Speaking of gold, don't believe in the sales pitch that gold rises with inflation. Gold rises in times of economic uncertainty or lack of trust with respect to governments. And this loss of confidence is the root of inflation. Do you see? Inflation is not a cause but an effect, a symptom, not an illness. Here we see gold charted in a basket of major currencies, establishing an upside break not seen in the chart of gold expressed in dollar terms. This tells us that gold is appreciating globally and that for many people around the world, gold is now more worthy compared to their domestic currencies. I hope you found this larger video useful. I've tried not to be contentious with my views. My aim is to show you how technical analysis can help us to think outside the narratives out there. Narratives that are all-encompassing and become very political. Something that charts ignore because they have their own way of making us understand what's happening in the world. Our job is to figure out the implications. Stay tuned for future videos on specific sector picks, metals and crypto where we already smell great opportunities ahead. For today, I leave you with two channel recommendations. One is Mark Vidal, an established channel in Spanish, and the other one is a new promising channel in English from Gary Tanashian. Enjoy them. Until the next one, have a fantastic day.